Hello and good evening, and welcome to this Prepare to Pass webinar for the paper F6 Taxation, Pakistani variant for the December 2019 exam session. Um, this is actually all of you who are actually attending this exam session. I'm actually going to share a few things with you people. First of all, basically, the taxation paper is available in the ACCA. I mean, the Pakistani variant is available in the ACCA qualification. And there was actually an understanding amongst the ACCA personnels that because of lack of resources available for the taxation paper, the students usually don't opt for the taxation Pakistani variant. So in order to ensure that resources are available, ACCA actually launched this initiative of conducting the Prepare to Pass session for the paper F6 Pakistan variant. Now, what I'm actually going to share with you people is that I conducted the same session in the September 2019 exam session. And during the September 2019 exam session, I actually covered up various aspects pertaining to this specific course. So, but the entire course was unfortunately not covered, obviously because of the lacking of the time. So, what I'm actually going to be doing is I'll be inshallah covering those areas of the syllabus which I had not earlier covered in the previous session. So before we proceed, I am going to give a quick introduction about myself. Mohammad Luqman Rafiq. I have been in teaching profession for more than 10 years now. I serve as a chief executive officer of a chartered accountancy college, which has got campuses in Karachi and in Sakkar. I have worked as a tax and corporate consultant at an advisory firm for a period of 7 years. So that's what I have actually been doing in the past. Now, before I proceed further, what I'm actually going to do is that I'm going to guide you people with respect to something that is going to help you all with respect to the preparation for the taxation paper. So I'm going to guide you people with respect to this ACCA Prepare to Pass. Now let's try to understand that what is this ACCA Practice to Pass Exam Approach webinar. When you are actually going to go onto the ACCA's website, you could see it's ACCA Global Pakistan page and student support for students in Pakistan. Then you have got Prepare to Pass ACCA Study School. If you go on to this page, what you will find over there in this page is on this left hand side, there is Practice to Pass, Revision Resources and Recorded Webinars. So when you are going to click on this, what would happen is you will come across this handout and links. All that you can do is that you can download it, and when you're going to download it, so you will come across the various a list of the handouts or the links for the various sessions that have been conducted in the past. See this performance management from December 17 to September 18, and then December 18 and then March 19. And if you could just look at this taxation, this is basically a UK variant. This is not Pakistan variant, but here it is the Pakistan variant. So this is the webinar which I actually conducted in the session for September 2019. And these are basically the 5 days video lectures. There is a link to this 5-day video lectures. What you could probably do is that you could see that this is how the session was conducted, and everything that I did is actually available recorded on this specific Vimeo website, and this can be opened and accessed through this link which I am actually showing to you. And what I would actually do is I would ensure that they also put a copy of this so that you could have a better approach and understanding to it. It's actually page number 6 of the handout, which we shall be needing. It actually covers up the link to the previous session that I conducted. So anyways, you people can access it. What I would do is that I would ask my this ACCA team member to share this with you people. Now I'm going to have a quick introduction about this taxation PK and variant paper. But before I proceed, I would just want to know if the people who are attending this specific session, if what is your background, why do you want to attend the session, and what are your objectives of attending the session, what do you want to achieve out of this specific session. If you could just share with me, that would be great for me, please. Yeah, if I could have a quick introduction about you people, that what is your background, what have you done, why are you attending the session. If I could have a quick idea about this, so that is actually going to help me deliver this session in a better manner, please. If I get response from your side, it will be better for me to conduct the session accordingly, to customize it according to your needs and expectations. So I think, okay, I have got some. You've got text, but could not. Okay, Rabi Saeed, thank you for your thing. Are you from Pakistan? Or are you from some other country? Yeah, are you from Pakistan? Okay, you're from Karachi. Okay, so basically, I just wanted to clarify that this specific session will be covering ACCA Pakistan variant. In fact, the taxation Pakistan variant, and not going to be covering the UK variant. Anyways, Rubad and private industry. Okay, good enough, Robert. Thank you. Thank you for your response. Now I'm going to start off. So we have got people who intend to attempt the paper. Uh, and there are few who want to know about the Pakistani laws and taxation. So anyways, I mean, good enough. You will have a good idea. As I mentioned earlier also, that here is actually, we are going to share with you. This is actually a slide which is available on the ACCA Pakistan website. And this specific slide actually has got the link to the various five sessions that I conducted in the September 2019 exam session, and this actually covers up the income tax portion of the taxation Pakistan variant. So you'll get a link through emails so that you can access it. Anyways, let's just start off. Let's have a quick discussion. So when we talk about the taxation Pakistan variant, so you need to understand that when it comes to taxation in Pakistan, there are various laws and regulations that are applicable and that actually define the tax law. So what are those laws and regulations that actually define the tax law? So the number one of them is the Income Tax Ordinance 2001, which covers the income tax rules. The second thing is income tax rules. So the income tax ordinance actually covers the main law, whereas the income tax rules give you a procedural method of implementing the taxation law in Pakistan. Then you've got Sales Tax Act. So it covers up the entire sales tax. And then you've got sales tax rules. The sales tax rules tell you how to implement the sales tax. Then there are a few Finance Act 2018 and Finance Amendment Act 2018. Now I'm going to help you people understand few things. Number one point is basically Finance Act. Now, when do we have a Finance Act that's being implemented and things like that? So let's try to understand. When we talk about the Finance Act, so in Pakistan, the tax year is the period for the calculation of your taxable income for the tax authorities is usually from 1st July till 30th June. The tax year is usually from 1st July till 30th June. Now, so what happens is, um, if we are talking about 30th June 2019, so what we actually had is the period from 1st July 18 till 30th June 2019 was governed by Finance Act 2018. And now the period, which is 1st July 2019 to 30th June 2020, will be covered by Finance Act 2019. So when we talk about the taxation variant paper of Pakistan, so you need to understand that this specific paper is conducted twice in a year, which is only June and December. It is not conducted it's not conducted in March and September. It's only June, December attempt that the exam is. So basically, what ACCA has done is ACCA mentions that, for example, if this is 1st July 18 to 30th June 2019 and the Finance Act 19 is 18 is applicable. So this Finance Act 18 is going to be applicable on the exam attempt for 30th June 2019 and 31st December 2019. And this Finance Act 2019 will be applicable on June 20 and December 20. So for us, what we will be covering is Finance Act 2018. We shall not be covering Finance Act 2019. That's what you need to understand first. So what is the Finance Act that we shall be covering? We shall be covering Finance Act 2018 only. We shall not be covering Finance Act 2019. Now let's move a bit forward. Let's start discussing. So this is a bit of a detail that I covered up. So it's actually already mentioned here in the slides, but I explained to you earlier through the explanation. Now, the important thing is, how is the paper examined? What is the approach to examining the syllabus? So when we talk about approach towards examination of the syllabus, so you need to understand that it's a 3-hour computer-based examination, and with a section A, which is worth 30 marks, and with a section B, which is worth 70 marks. So it's section A, 30 marks, section B, which is 70 marks. Now, if you talk about section A, so it says the section A will have 15 MCQs, 2 marks each, so that makes it 30. And in the section B, what will happen is there will be 4 questions of 10 marks each, and there will be 2 questions of 15 marks each. These are all going to be subjective questions. They would not be MCQ based like the other examination papers. It will be something that is going to be a short question on which you'll have to answer on Excel, or you might have to answer on Word. So that is what it is going to be. Now, one more thing which you need to understand is that the 2 questions of 15 marks each, the ACCA syllabus has specifically defined that one of the question is going to be for individual and one of them is going to be for company. Okay. Rabi Saeed is asking that section B have long question. Yes, section B have all long question. There are no MTQs, there are no OTQs, they're all long questions. Okay, let's actually discuss a bit further about the relational diagram of the syllabus. So I'll have a quick discussion about the syllabus. If you could just have a quick look at the syllabus. So you would see that there are 4 sections to the syllabus. One of them is this section A, which covers the tax administration and systems. Section B, which is basically the income tax liability of individual and unincorporated bodies, then of companies, then there is this capital gains, and then there is this sales tax. So let me explain to you people that in the previous webinar, I have covered this specific area around 70%, and 30% of this is about to be covered. This was covered 100%, and this is 0% covered, so it's 100% going to be covered in this specific webinar session. Furthermore, I'll have a quick discussion on this specific, like maximum 1 hour, which I'll be covering. So we have done 70% of the income tax liabilities of individual and unincorporated bodies and income tax liabilities of companies. So if anyone preparing for the examination in December, or if anyone wanting to know the taxation law of Pakistan, so these webinars, which is 5 sessions in the previous session, and 5 more session going to be inshallah happening in the current session. This is going to guide you about the complete. This is going to guide you about the complete uh, taxation paper. This is going to give you a complete guidance about taxation paper. Now let's see. Let's move a bit forward, and this part A, which is about tax system and administration, what is it actually covering? So the tax system and administration has 2 things. First of all, it covers up the general. It covers up the general application of what taxes, how the taxes imposed, how the taxes are collected, and what are the objectives of taxes, and etc., etc., etc. Plus, there is this specific part of this specific section, and this is about the procedures, appeals, etc., etc. A very important area with respect to any tax practitioner, a very important area with respect to any person who is managing their taxes. So it's a very important area which we shall also be covering. Okay, and the second thing is income tax liabilities of individuals and unincorporated bodies. So unincorporated bodies, what does it actually refer to, the unincorporated bodies? So the unincorporated bodies are generally the AOP or the joint ventures which are not incorporated as a company. So basically in Pakistani tax law, there are 5 heads of income, which is the income from employment, which is the salary. Then you've got income from business, income from property, other sources, and then there is another section which is capital gain. So this is all something that is applicable on the individuals, and then this is also applicable on the companies also. Then you've got capital gains. So when I talk about the capital gains, what I have majorly covered in the previous section is these two, but I have not majorly covered up this specific section. So I shall be covering this specific part of taxation also. Lastly, the sales tax. So we haven't done anything about the sales tax in the previous session. We shall be covering the entire sales tax in this specific section. So the entire sales tax will be covered in this specific session. Anyways, so that actually marks the conclusion of the syllabus introduction. Anyone has any questions till now? If that's fine, then I can actually proceed further and I can discuss further. If anyone has any question, please do ask. Okay, Rubaid Hussain is asking a question. The variant I am studying currently has 3 sections. Even though I'm from Lahore, I'm studying English tax system. This is confusing me. Please detail me in this situation. Rubaid, as I mentioned, this webinar is for the taxation Pakistan variant. This webinar is not for attending the UK variant. If you want to attend the UK variant, unfortunately, it's not being conducted by ACCA in this current session. So you'll have to rely on some other tutor or something for this specific. But if you want to attend for Pakistan variant, this is what it is. What you could do is that you could check your exam entry, that that what is the exam entry, and then you can have an idea. Rabi said yes, ACCA Pakistan website has got the past papers. And what I would suggest to you is that you can have a more comprehensive preparation by opting for a book by Mr. Khalid Petiwala. So you can opt Mr. Khalid Petiwala's book for taxation, and it is going to help you a lot with respect to the exam practice questions. Okay, let's just start off. So the first thing that I shall be doing is I will be starting off with the sales tax. Now, when I talk about the sales tax, so let's have a quick introduction about what exactly is the sales tax. So when we talk about the concept of sales tax, a lot of you people study the basic concept of sales tax when you study financial accounting paper. But let's have a quick recall and a quick discussion about how the sales tax operates and what exactly is the sales tax all about. Zishan Abdul Rahman, the book. Zishan Abdul Rahman, uh, mm, the book for sales tax, it's the same Khalid Petiwala book you can take. Rubaid Hussain, if you have passed the taxation examination in your previous qualification, so you must have got an exemption into it. So you don't actually have to attend the paper. I'm surprised that why do you want to attend the paper? Because you must have got an exemption on it. Anyways, so let's just start off. If I talk about sales tax, so when we talk about the sales tax is referred to through various names in various jurisdictions. Generally speaking, if I talk about that, why exactly is the sales tax imposed on any entity? So the major purpose of sales tax is that sales tax is actually a consumption tax. Now, why is it a consumption tax? It is to discourage consumption. It is to discourage consumption of goods. So the original purpose and the original objective of introducing the sales tax was that the luxuries were to be supposed to be taxed in order to ensure that the consumption of the luxury goods is discouraged amongst the common population. Sales tax had an impact that it usually discourages import of goods. It usually discourages people from relying more on the luxury goods, and rather they utilize the normal goods which would serve the same purpose. So that is what sales tax is. Number one, a consumption tax. Number two is general sales tax. So a lot of countries, what the sales tax is generally applied is as a source of revenue. The basic objective is to derive the revenue rather than uh, discouraging consumption. So sales tax majorly revenue, or it is considered to be a consumption tax, which is to discourage consumption. The sales tax could commonly be referred as VAT also, and the multi-stage tax. Now, let me actually explain to you that how does sales tax operate? What are the components that we need to consider when we talk about the sales tax? So first of all, there are a few important terminologies that you actually need to understand with respect to sales tax. Everyone who is attending this session or who would be listening to this section, I can guarantee you that every one of you pays sales tax. Now, where do we pay sales tax? We pay sales tax everywhere. Where do we pay sales tax? So we pay sales tax on the mineral water that we consume. We pay sales tax on the packaged biscuits that we eat, the chips that we eat, the milk that we buy, the Tetra Pak milk that we buy. Um, any processed item, any packaged item, we pay sales tax on it. Then if you have got an internet connection at your place, you pay sales tax on it. If you have got a mobile phone, so every single mobile phone call that you make, you are being charged a federal excise duty or a sales tax. So when we talk about the concept of sales tax, so sales tax is one of those things which everybody of us ultimately pays, whether you are somebody who's earning money, who is not earning money, you are somebody who's a student, you are somebody who is an internee, you're somebody who is an unemployed person, every one of us pays sales tax. Now, so the various terminologies that the sales tax actually covers up is, there's one thing which is called input tax. Now, what exactly do we mean by input tax? So the input tax is the tax paid on purchase of goods. So whenever you purchase anything, the tax that you pay on the purchase of goods is considered to be input tax. So what's an input tax? It's the tax that we pay on the purchase of goods. For those of you who want to actually have an access to this slide that I'm using, so you can access the handouts in the handout sections on your webinar window. Okay, the next thing is the output tax. When we talk about the concept of output tax, so the output tax actually refers to the tax collected from sales. When we make sales, so what we do is that at the time of making sales, we collect sales tax from our customers. So whatever the tax that we collect from our customers, it is considered to be output tax. Now, the third thing is called the sales tax liability. So what's a sales tax liability? It's an input and outputs difference is called sales tax liability. Like for example, you've got 1,000 rupees of output tax, that is you have collected from the sales. You paid 700 while purchasing the goods. So you've got an input tax of 700. Resultingly, this 300 is going to be considered as your sales tax liability. So when I talk about the concept of sales tax liability, so what's a sales tax liability? It's the difference between output and input. So output minus input is called sales tax liability. Now let's move a bit forward. So if we move a bit forward, let's discuss about it. I'm going to explain to you one more thing. When we talk about the sales tax can be imposed on goods and the sales tax can be imposed on services. Sales tax can be imposed on goods. The sales tax can be imposed on services. When we talk about the imposition of sales tax on goods, when we talk about the imposition of sales tax on services, so in Pakistan, basically what has happened is, there is something you might have heard in the news and might have heard in the discussions, which is called 18th Amendment. Now, what is this 18th Amendment? This 18th Amendment was an amendment to the Constitution of Pakistan. It was the 18th time that the Constitution of Pakistan was amended. Now, when we talk about this 18th Amendment, so you need to understand this thing that according to the 18th Amendment, the right to collect sales tax on the goods is with FBR. The right to collect the sales tax on goods is with the federal government, and the right to collect sales tax on services is actually with the provincial government. So, like what happens is the federal government has its own department which is called FBR, the Federal Board of Revenue, and the provincial governments, various governments have got various departments, which is SRB by the Sindh Revenue Board, PRA for the Punjab Revenue Authority, and then there is this KPKRA, which is the KPK Revenue Authority. So these are the various authorities that collect the sales tax. So there was actually a problem, with respect to how the provinces used to complain that they don't get their share of taxes from the federal government. So as a result of this, in order to ensure that there is no dispute between the provinces and the federal government, so this 18th Amendment was passed, and in accordance with the 18th Amendment, what actually happened was that the right to collect sales tax on goods was given to. Right to collect sales tax on goods was actually given to the federal government, and the right to collect sales tax on services was being given to the provincial government. So that's how it actually went about. Now, so in our syllabus, we shall only be covering the sales tax on goods, which is the law of FBR. We shall not be covering the law of the various service authorities. Now let's talk about the sales tax dynamic, that how does sales tax operates and how do things go about. So in order to explain to you people that how the sales tax operate, I'm going to take this a specific example where I've mentioned about a manufacturer, then a distributor, then a wholesaler, then a retailer, and then a consumer. Now, if I talk about it, that how exactly it goes about manufacturer, distributor, wholesaler, retailer, and consumer. Let's talk and let's discuss. Okay, so how do things actually go about? Now, in order to help you understand, I'm going to take a simple example, which is that assume that the sales tax rate is 10%. Sales tax rate is 10%. So a manufacturer, he manufactures the goods and he sells those goods to distributor. The price that he charges to the distributor is basically the price charged by the manufacturer to distributor is, let's say, 100 rupee. And on this, he imposes a sales tax of 10%. So if he imposes a sales tax of 10%, he actually charges this distributor 110 rupees. So what is this manufacturer going to do? He's going to pass this double entry that is going to say that receivable debit by 110, the sales will be credited by 100, and the sales tax will be credited by 10. If I talk about this manufacturer would say that I have actually got, and if I talk from the perspective of this manufacturer, the manufacturer would say that his output is 10 and his input is 0. So resultingly, he pays a sales tax liability of 10 to the government of Pakistan. Try to understand. How does the sales tax dynamic operate? A manufacturer manufactures the goods, and after manufacturing these goods, what he did was he transferred those goods to the distributor. And the price that he charged for the goods was 100 rupee. And upon 100 rupee, he charged a tax of 10%. So it became 110. When it became 110, so what happened is the double entry that he passed was he said that receivable or cash debit by 110, sales is going to be credited by 100, and the sales tax is going to be credited by 10. Now, when we talk about the sales tax is going to be credited by 10, so what is this sales tax? This is actually his output tax. So he's going to say output tax is 10, input tax is 0, the sales tax liability turns out to be 10. Is that okay to everyone? Now let's move. So he's going to give this 10 rupee to the government. The next stage is about the distributor. Assume that this distributor, he sold the goods. He sold the goods to the wholesaler. And when he sold the goods to wholesaler, assume that he sold the goods to wholesaler at 120. So the price that he is charging is 120. The sales tax is going to be 12. So it will become 132. Now, what will happen is this distributor, what he is going to do is that he's going to say that my output is 12 and my input is 10. So resultingly, his sales tax liability is going to be 2. His sales tax liability is going to be 2. Now, try to understand. What happens is the distributor, when he purchased the good, so he would have said that sales tax debit by 10, purchases debit by 100, and payable credit by 110. He would have recorded like this. Now, when we talk about the distributor, how is he going to record? He's going to record receivable debit by 132. The sales are going to be credited by 120, and sales tax is going to be credited by 12. So this is basically going to happen with it. Now, is everyone okay with this? Is everyone okay with this whole double entry and the movement and everything? Is everyone okay with it? Okay, now Dishan Abdul Rahman, you're asking that when manufacturer is making third schedule goods, kindly explain the same in that case. Okay, just hold on for a bit. A lot of people attending the webinar might not actually know that what is the third schedule item. So just wait for a bit that how is it actually going to operate. Now, then this cycle goes on and the distributor sells to wholesaler, the wholesaler sells to retailer. Assume that he sells it to 150. So the price is going to be 150, the sales tax is going to be 15, gives you 165. And this wholesaler would have said sales tax debited by 12 and the purchases debited by 120 and the payable credit by 132. And at the same time, when this wholesaler actually sells the goods, he would have recorded receivable debit by 150 and then at the same time sales credit, sorry, not 150, it's 165. Sales credit by 150 and sales tax credit by 15. This is how it is going to be. Now, if I talk a bit further, so what am I going to do? I'm going to say that the output tax is going to be 15, the input tax is going to be 12. So resultingly, it becomes 3. So resultingly, it becomes 3. So it will go on, and let's try to understand this thing that when we talk about the retailer, so assume that retailer, the price that he charges to customer is, assume that it's 180 and the sales tax that he imposes is 18. So 198 is the selling price by the retailer to the consumer. Now, how is consumer going to record? The consumer is the ultimate bearer of the sales tax. He's going to say purchases debit by 198 and he's going to say cash credited by 198. Now, this retailer, what he would do is that the retailer would have his output at 18, his input at 15. So resultingly 3 rupees is his sales tax liability. Now, let's try to actually trace the whole cycle and have an understanding that how do things operate. First of all, manufactured the goods. He sold the goods to distributor for 100, charged a sales tax of 10, so it became 110. He said receivable debit, sales tax credit and sales credit. His output was 10, his input was 0. He gave 10 to the government. The same cycle happened. Distributor sold it for 120, sales tax was 12. His output was 12, his input was 10, so he paid sales tax liability of 2. Wholesaler, output was 15, input was 12, 3. Retailer. Now, what is this happening? This is happening with respect to the retailer. Now, if it happens with the retailer, it's output 18, the input is 15, and the sales tax liability is 3. So basically now, let's try to understand. What happens is, we use the word multi-stage tax. If you could just remember, I use the word multi-stage tax. A sales tax is a multi-stage tax because what happens is, just try to figure out. At this point of time, the government, how much did they receive from here? The manufacturer 10. They received 2 from the distributor. They received 3 from the wholesaler and they received 3 from the retailer. So if you sum up how much did the government got, it's 10 plus 2 plus 3 plus 3. So it's actually 12 plus 3, 15 plus 3, 18. So 18 is what the government actually got. And how much sales tax has the consumer paid? He also paid 18. But what had happened is the sales tax that was passed on to the government was actually passed on in stages. It wasn't passed on immediately. It was passed on in multiple stages. And what were those multiple stages? Some of the input tax was paid by the manufacturer, some was paid by the wholesaler, some was paid by distributor, and some was paid by the retailer. So this is how the government gets its shares of sales tax. So because this sales tax is payable in multiple steps, multiple stages, through multiple parties involved, this is actually called a multi-stage tax. That's one of the reasons. Now, is everyone okay with this? Okay, let's move a bit forward. And there's another thing which this specific sales tax is referred to as, and that is called value added tax, VAT. In UK, it's termed as VAT, value added tax. Now, why is it termed as value added tax? So you need to understand. Basically, what is value addition? When we talk about the concept of value addition, a value addition actually means that when you add value to something, value addition is when you add value to something, that's called value addition. Now let's try to understand. Basically, the manufacturer, he produced something from the scratch and he sold it for 100. So the value that he created was of 100. So the sales tax that he paid was on 100 into 10% gives him 10. So that was the value added by him. Now let's move forward. The distributor, he purchased these goods for 100 and he sold them for 120. He purchased them for 100 and he sold them for 120. If you try to identify that how much value has this distributor added, so he's added a value of 20. Now, why is this distributor charging 20 extra? Probably because he has purchased in bulk and he is selling in various splitted pieces and so and so. So basically, this 20 is the value addition. Multiply by the 20 is the value addition, and this is multiplied by 10% gives you 2, and this is the value added portion of the tax, because the sales tax here is 12, whereas they originally paid an input of 10, so resultingly the value addition is 2. So every single person who is involved in the supply chain adds some value. Every single person who is in the supply chain adds some value. That's what the concept of value addition is. Is everyone okay with this? So basically we call sales tax, multi-stage tax, value-added tax, etc., etc. That's what we actually call them up, because the reason behind that is this is what the ultimate purpose is. The ultimate purpose for few countries, it's actually to discourage consumption. For few countries, it's actually a major source of revenue collection. Like in Pakistan, the sales tax, which is actually an indirect method of collecting the tax, is the sales tax is basically the majorly used by the government to derive the revenue. That's what they actually charge it here in Pakistan for. Now, so we are done with this specific portion where we have discussed the sales tax dynamic. Now, there are other terminologies which I would want you people to understand, which is when we come across the exam questions on sales tax. So we actually get various types of values, and those values could be an inclusive value, could be an exclusive value. What's an inclusive value? What's an exclusive value? So inclusive value means the value of good is stated inclusive of sales tax. Like for example, uh, if you are being told in the exam that you made a purchases of 100,000 and this is inclusive value with 10% sales tax. So what does this mean? This actually means that the purchases of 100,000 that you have made is basically 110%. Why? Because it includes a 10% sales tax. So X is going to be 100%. X is going to be 100%. So when we talk about the inclusive value means that it includes the effect of sales tax. So basically, the the value of purchase is going to be 90909, and the sales tax paid on this is going to be 9091. So like basically what happens is, if you are being given an inclusive value, the inclusive value means the value includes the effect of sales tax. And when we are being given the exclusive value is a value which is excluding sales tax. That means the sales tax needs to be imposed on it. The exclusive value means the sales tax need to be imposed on it. Now, how exactly are we going to impose the sales tax upon it? So the sales tax is going to be imposed like this. It's going to be 100,000 is 100%. So X is basically 10%. So it's just like 100,000 into 10%. It'll give you the sales tax value, which is 10,000. So this is how it goes about. So you can have, when you come across a question, you can have an inclusive value, you can have an exclusive value, depending upon how the examiner is attempting or giving the question. Now, let's move a bit forward and let's talk a bit further, which is concept of registered and unregistered person. Now, I'm going to explain to you that what a registered person is and what an unregistered person is. Let's try to understand. Remember that we are studying Pakistani taxation. We're not studying UK taxation. So you may come across few of the terminologies which are not going to be similar to what you might have studied in the UK taxation. Now, when we talk about the concept of registered and unregistered person, so you need to understand that uh, the income tax and the sales tax, they are two different regimes. When we talk about income tax is an altogether different regime, and when we talk about sales tax, it's a very different ball game. Every person who is an NTN holder means national tax number holder, is considered to be a registered taxpayer. I mean, there is a concept which is called taxpayer. So what is a taxpayer? Anyone who has an NTN is called a taxpayer. Anyone who has an NTN, the national tax number, is called a registered person. It's called a taxpayer. But is that person also termed as registered for sales tax? The answer is no. When we talk about the concept of registered and unregistered person, a registered person means person who is registered for sales tax. A registered person means a person who is registered for sales tax. So generally speaking, I'm not complicating things a lot, but I'm just going to explain to you that there is a procedure for registration. There is a procedure for registration and there is a requirement to register. There is a procedure to register and there is actually a requirement to register. That's what you have to follow. So not everyone is required to be registered. It's actually dependent upon that. Okay, so basically what happens is not everyone is required to be registered. It's only depending upon if you meet certain requirements, then you are required to be registered. We shall be discussing that who is required to be registered for sales tax and who is not required to be registered in our session tomorrow. But for the time being, let's try to understand that anyone who actually meets a certain sales threshold is required to be registered, and otherwise you're not required to be registered. Now, the next is unregistered person. Who is an unregistered person? A person who is not registered for sales tax purposes. Now, what exactly is the difference between this registered and unregistered person? So I'm going to explain to you, because I would relate it to the practical life that we face day to day. First of all, if you are a registered person, you are eligible to charge sales tax on supplies. So whatever that you are going to supply, you are eligible to charge sales tax on your supplies. So you can charge sales tax on your supplies if you are registered. Number two, the input tax that you have paid at the time of making a purchase, it can be adjusted or it can be refunded. Now let's try to understand. Basically what happens is, a lot of restaurants operating in Pakistan, what they do is that when you go to eat, so they charge you a sales tax. Now, obviously the sales tax that they charge is SRB, Sindh Revenue Board tax, or it's a PRA tax. So it's actually sales tax on services that they charge us. When we go and eat at any restaurant, what they do is that they charge us a sales tax on services. Now, a very important thing is, a lot of restaurants are not registered for sales tax purposes, and they're just charging sales tax to the public at large, and they're just keeping the entire sales tax in their own pockets. The government of Pakistan, what it did was, it actually took very serious action against it, because when you go and eat at a restaurant and they charge you sales tax and you ask them where is your sales tax number, they'll show you their NTN. Remember, their NTN is not their sales tax number. They need to show you their SNTN if they are in Sindh, or their PNTN if they are in Punjab. So it's actually, what happens is, the Sindh national tax number or the Punjab national tax number. It's basically the sales tax registration for the purposes of services. Only if you are registered, then can you charge tax. Otherwise, you cannot charge tax. It's important. So a lot of restaurants, what they do is that they charge sales tax. The people, they don't argue with them, and people just pay the tax, because generally a mindset is there amongst a lot of people that the XYZ restaurant is going to be registered. But the practical scenario is, unfortunately, a lot of restaurants are not registered and they're still charging sales tax. And that's a bogus sales tax that they are charging, and they're keeping that money with themselves and not depositing it to the government, unfortunately. Anyways. So let's move a bit forward now. So um, depending upon whether you are required to be registered for sales tax, you get registered. If you get registered, then the advantage of registration is, all the input tax that you pay, you can claim an adjustment against it, or you can claim a refund. And number two is, you are eligible to charge sales tax on whatever supplies that you make. So like, the advantages or the things that are connected with the registration is, you can charge sales tax and you are eligible to claim adjustment/refund. Now let's move forward. If I move a bit forward, so what I'm going to do is, I'm going to discuss about how this sales tax workings are done. So first of all, what I've done is, I've put in front of you a computation of an input tax. It's a sample computation. Just have a look at it and then we'll discuss about it. Now, if I talk about this input tax computation, so let's try to understand. When we talk about the input tax computation, here what I have done is I've mentioned an example where this is the description and this is the taxable value and this is the rate of sales tax applicable and this is the amount of sales tax. In Pakistan, the rate of general sales tax is 17%. The GST rate is 17%. So if there is nothing mentioned, then the tax rate applicable universally is 17%. And remember, we are talking about goods, we are not talking about services. For services, there is a different set of rules and there is a different set of tax rates. So what happened is, let's say, when we talk about input tax computation, so assume that you made purchases from a registered person, from somebody who is registered. You made a purchase of 1.5 million. There was a 17% rate applicable on it. So resultingly, the amount of sales tax that you will be paying is 255,000. The next thing that happens is there's a purchases from unregistered person. Now, when you purchase goods from unregistered person, an unregistered person is not eligible to charge sales tax because he's not registered. If he is not registered, then he cannot charge sales tax, so the sales tax would not be applicable on it. Why? Because you purchased from unregistered person. So you cannot claim input for these purchases. The third thing is import of goods. Now, who charges the sales tax on import of goods? So it's actually the custom authorities. The custom authority comes under the FBR, Federal Board of Revenue. Custom authority actually charges this sales tax on the import of goods. So at the time of clearance from the port, what you need to do is that you need to pay tax to the custom authorities in respect of whatever purchases that you have made. So custom authorities, they charge sales tax on import of goods. So resultingly what happens is this is the total amount of sales tax that is payable. 255 plus 68, etc., etc. Is it okay to everyone? I'm going to explain few things more in detail, but I'm just going through a quick review of how the sales tax operates. Okay, now let's move a bit forward. Now let's talk about the output tax computation. So when you actually make purchases of goods, so you paid input, now you are making sales. So when you are making sales, so there is actually going to be a computation of output tax. When we talk about the computation of output tax, how do output tax actually operate? Try to understand that output tax operate. This is a pro forma for the computation of output tax. I'm going to explain whatever the things are in more detail when I move forward. So you made a sales to registered person. When you made a sales to registered person, and since you were yourself registered, so you charge a sales tax of 17%. This was the amount of sales tax applicable. Now you're making a sales to unregistered person. For that person, its purchases, he cannot claim input, but you will have to charge output. So this 1.25 million into 17% gives you 212,500. So when it gives you 212,500, this is what the unregistered person sales is going to be. Now, let's move a bit forward. Let's try to discuss further. There is a law which says that if you make sales to unregistered person, so because that person is unregistered, and the tax authorities, they want to discourage unregistered people from operating. So you shall have to impose a further tax on registered person for a period of 3%. So you will actually charge a further tax on unregistered sales for 3% of whatever the sales value. Now you would say that why have you not included this in the output? I have included it after the output tax on sales. Why? Because as per the definition given under the Sales Tax Act, the further tax is not part of output tax, but this is how it is actually quoted whenever you're computing, whenever you're performing a computation in the exam question. So sales to registered person, then there is this sales to unregistered person. When you make exports, the exports in Pakistan are subject to 0%. The exports in Pakistan are subject to 0% in order to encourage the exports. So if I'm an exporter, my sales will be taxed at 0%, but but I will be paying tax on my purchases. So resultingly what happens is my output tax would be 0, but I'll have an input tax. So generally an exporter, what he does is he goes for the refund. The exporter, what he does is he goes for a refund. So generally what happens is the exporter goes for a refund. Now let's move a bit forward. If I talk a bit forward, so what happens is there is this exempt supply. Now what is this exempt supply? Let's try to understand the exempt supplies. There are certain category of the goods which government has mentioned that they would not be subject to sales tax. Like for example, basic necessities like you're buying wheat flour, you're buying sugar, you're buying salt, provided all of them are not packaged, providing they are not packaged, they're not further processed. Because what happens is if they are packaged under a specific packing and so on, then a sales tax would be applicable, but generally an open thing would not be having a sales tax. Okay, Zishan Abdul Rahman has a question. He says that when you make purchases from unregistered person, you are required to withhold sales tax of 5%. Yes, as per the new law, that's what you have to do. That 5%. But if registered person is in tax exempt zone, what will happen to them? So if they are in tax exempt zone, so that means the sales tax would not be applicable upon them, and you shall have to actually not charge the sales tax upon them, because then it would be supplying to somebody with an exemption available. They're not required to be registered. Anyways, then you've got exempt supplies. So resultingly, this is the output tax on sales, and then you add a further tax to it. So you get this 505,000. Now move forward. How would we make a sales tax liability computation? So sales tax liability computation is performed like this. You've got output tax on sales. I've carried forward the same example, which is 467,500. What have you got? You've got output tax, which is 467,500. Now what will happen is there is actually going to be an input tax adjustment. The input tax adjustment is going to be 90% of outputs or actual input, whichever is lower. So here in this case, the 90% of this output turned out to be 427.50. Whereas the input tax was 323,000. Since the lower amount was for the input tax, so the input tax was considered. And when the input tax was considered, so what happened is 323,000 was the lower amount, so it was 467,500 less 323, and then a further tax was added to your sales tax liability. Resultingly, you need to pay this 182,000 to the government. So basically, this is how the sales tax computation is done. How? What you do is that you perform this input tax and output tax computation. You perform a computation for input tax and output tax. And when we have got this input tax and output tax, see, this is input tax, this is output tax computation. You perform this computation, and once you have performed, so you have the sales tax liability computation. Is it okay to everyone? Okay, so this is a very basic of the sales tax that I am discussing right now. This is a very basic of the sales tax that I am discussing right now. Okay, is it fine to everyone? Okay, before we proceed further, what I'll do is that I shall have a short break of let's say 10 minutes, and then we will resume further. So I'll have a break till this is actually going to be a break till 9:20 p.m. Okay, welcome back. So before this break, what we have actually discussed is I will have a quick review of what we have done up till now. We have discussed the basic concept of sales tax. We have discussed that what is input, output, and the sales tax liability. We have discussed the operational dynamics of the sales tax. Furthermore, we have talked about the inclusive value and the exclusive value concept. And then we've also talked about the registered and unregistered person concept. The further thing that we have done is we have discussed the concept of registered and unregistered person in the sales tax. And in addition to this, I have gone through a sample calculation for input tax and a sample calculation for output tax and the sales tax liability. So that is what we did before the break. Now let's actually start off and let's start discussing. Now before going forward, what I'm actually going to tell you is that you need to understand that in order to attempt the sales tax exam question, you need to understand the various terminologies and the various terms that are involved in sales tax, because if you are going to understand those terminologies, then you will be able to actually attempt the sales tax question. Otherwise you will not be able to attempt the sales tax question. So now when we talk about the supply of goods can be classified into the multiple categories. The first one of them is called taxable supply. What is the first one? The first one is termed as taxable supply. Now, what is the definition of a taxable supply? It says taxable supply means a supply of taxable goods made by an importer. So who is actually doing it? It's made by an importer, a manufacturer, a wholesaler, or a distributor or retailer, other than a supply of goods which is exempt under section 13 and includes a supply of goods chargeable to tax at the rate of 0%, so and so, so and so. Now, so in simple terms, a supply which is made by importer or a manufacturer or a wholesaler or dealer or distributor or a retailer, so that is all going to be considered as a taxable supply, other than the supply of goods which is exempt. So other than the supply of goods which is exempt, so basically what happens is there are specific supplies which are considered to be exempt as per the tax laws. Now let's move a bit forward. Let's try to discuss the concept of exempt supply. Now, when we talk about the concept of exempt supply, so you need to try and understand that what an exempt supply actually means. Exempt supply, as the word exempt, it indicates that a supply which is going to be exempt from tax, a supply which will be exempt from tax. So supply which will be exempt from tax. Now, what are those supplies which are exempt from tax? So for that, you need to understand that it says that section 13 stipulates that following goods are exempt from levy of tax. Now, what are those goods? Number one, the goods which are mentioned in 6th schedule. So remember, for those of you who are new to it, every tax law in Pakistan has got some schedules. Schedules are basically attachments to the tax laws. So these schedule, it's a 6th schedule. 6th schedule has a list of items which are those on which no tax will be imposed. For those of you who may actually wish to know that in practical life, how do we actually get an access to the taxation law. So I am just going to guide you. This is the website of Federal Board of Revenue, the Federal Board of Revenue. And what happens is on this Federal Board of Revenue website, you'll have this acts and ordinances and rules and so and so, so and so. If you click on this, you will come across the Sales Tax Act somewhere. It's Sales Tax Act 1990, and this is amended up till 30th June. So what I'm going to do is that I'm going to just save it with myself and then open up and show you people. So the Sales Tax Act is what it is. And when you'll go into the Sales Tax Act, you'll find that this is the whole Sales Tax Act and it has got various attachments to it. What are these various attachments to it? Like this is the various schedules, the first schedule, second schedule, third schedule, fourth, fifth, sixth, etc., etc. I'm going to go directly to the 6th schedule, and just to have just to help you people understand that how things actually operate in this specific schedule. Okay, here it is, the sixth schedule. So the sixth schedule actually has got this list, which is a complete list of what is included in this specific sixth schedule. So so this is basically live animals, and then it says meat, the fish, eggs including eggs for hatching, live plants including bulbs, edible vegetable oils, etc., etc., pulses, edible fruits, etc. So these are the various things that are included here. So now if we make, now you don't have to remember all this. All that you need to know is that you need to know that what is the sixth schedule. So every item which is mentioned under the sixth schedule is exempt from sales tax. Every item which is basically mentioned under the sixth schedule is exempt from sales tax. That means when you make a supply of it, you don't charge any sales tax on it. Furthermore, it says the goods is specified by federal government through its SROs. Now, what is these SROs? Let's try to understand. In the taxation law, the SRO actually stands for Statutory Requisition Order. Statutory Requisition Order. So what is it? It's a statutory requisition order. Now, when I talk about the statutory requisition order, try to understand what it is. The statutory requisition order actually refers to basically what happens is the government over a period of time, what it does is that it issues various pronouncements. And what are those pronouncements? The pronouncements are actually for the purpose of the various pronouncements made by the government are largely with an objective of issuing something that they had actually forgotten or that they didn't know that it was supposed to be introduced through the Finance Act. So if they have forgotten or missed out on something, so they introduce that through an SRO. So SRO also constitutes a part of a law. So SRO is also part of a law. Now let's move forward. So basically, what's an exempt supply? A supply which is mentioned in sixth schedule or is mentioned in a specific SRO. Now, there is another supply which is called zero rated supply. What is this zero rated supply? So the law says that zero rated supply is a supply which is taxed at the rate of 0%, which is taxed at the rate of 0%. Now, there's a difference between what an exempt supply is and what a zero rated supply is. Try to understand. When we talk about the exempt supply, the sales tax is not charged on it. When we talk about the zero rated supply, the sales tax is charged on it, but at the rate of 0%. The sales tax is charged on it, but at the rate of 0%. That's what the difference is. Now, what is the impact of this specific difference? When we talk about the impact of this specific difference, so try to understand the impact of this specific difference. Uh, the impact of this difference is when you've got the exempt supply. When you've got the exempt supply, the input tax adjustment cannot be claimed. But when it comes to zero rated, the input tax adjustment can be claimed or it can be refunded to the person who is making the exempt supply, to the person who is making a zero rated supply. So that's where the difference actually falls. How exempt is input rated, the exempt supply, the input is disallowed, whereas when it comes to the zero rated, the input is allowed. Now let's move. The zero rated supply, there are a few more things which you need to understand with respect to zero rated supply and what exactly are they. Now, generally it says the zero rated supply goods exported or the goods is specified in the fifth schedule. So the goods which are exported, whatever that is exported, is going to be considered as zero rated. Whatever that is exported will be considered as zero rated. And the number two thing is the goods is specified in the fifth schedule. Now, as I mentioned to you people about the sixth schedule, let's actually have go through of the fifth schedule also, that what exactly is there in the fifth schedule. You will have just an idea that what is the fifth schedule. So everything that's mentioned in the fifth schedule is to be charged at 0%. Now let's see. Supply, repair or maintenance of any ship which is neither a ship of gross tonnage of less than so and so, etc., etc. That says supplies to diplomatic missions, supplies to duty-free shops, supplies of raw material to the manufacturer of goods in the export processing zone. Now, uh, you were asking a question, Zishan Abdur Rahman, that what will we do when we are supplying the goods to somebody who is actually in the export processing zone. So if somebody who is in the export processing zone, he is not required to be registered. So what you are doing is that when you are selling goods to them, so the goods are actually being exported, because um, even if you are in Pakistan and there are various export processing zones that the government has actually made. So if you supply the goods into those export processing zone, that is going to be considered as an export. If you supply the goods to those export processing zone, that is going to be considered as an export. So here it is that the supplies of raw materials, components and other goods for further manufacture of goods and EPZ, that's also subject to 0%. So anyways, that's how the list goes about, that what is the zero rated. So one of them is the goods which are exported. Number two, the goods which are mentioned in the fifth schedule. Okay, let's move a bit forward. Let's try to understand. Then it says the supply of stores and provisions. Supply of stores and provision for consumption aboard a conveyance proceeding to a destination outside Pakistan as specified in Section 24 of Customs Act 1969. Now, what exactly is it? A conveyance proceeding to a destination outside Pakistan. Like, for example, if you've got a plane, PIA airplane or an Emirates Airlines plane or a Qatar Airways plane, if it is going outside Pakistan and if you are supplying goods to that plane for consumption, not for ultimate sale on board the plane, for consumption on board the plane, which is destined to go outside Pakistan, then that is also going to be considered as a supply which is subject to 0%. Now, one more thing you need to understand. For example, if you're supplying goods to, if you are supplying goods to a conveyance which is operating within within Pakistan, like let's say for example, there's a plane which is going from Karachi to Lahore, or from Lahore to Islamabad, and if you're supplying goods onto them, that is going to be a taxable supply. That won't be a zero rated supply. The important thing is the destination should be outside Pakistan. The destination should be outside Pakistan. If the destination is not outside Pakistan, it's not going to be considered as an zero rated supply. The third thing is, it says such other goods as the board with the approval of minister in charge by notification in the official gazette is specified. So the official gazette is generally the publication of the government in which the government specifies the various goods on which the zero rating is going to be applicable. So if the government has specified a goods on which zero rating has to be applied irrespective of whether they are mentioned in the fifth schedule or not, then what happens is that is also going to be considered as a zero rated supply. Now, a very important point here is that there are few things which which are not considered to be zero rated. I'm going to explain to you. There are few things which are not considered to be zero rated. Now, what are those things which are not considered to be zero rated? It's very important to understand that. Now, first of all, it says that goods which are exported but have been or are intended to be re-imported into Pakistan. A very important point. At times what happens is there are few things which are exported out of Pakistan just for the sake of repackaging just for the sake of making them say that it's made in Dubai or made in UAE or made in Qatar or etc., and they're re-imported into Pakistan. Because what happens is the buyer at times, what happens is they do ask for the um, uh, bill of lading, which would indicate that the goods have been imported into Pakistan. So if you are specifically exporting the goods out of the country with the purpose of re-importing them into the country, then they will not be considered as applicable. Then zero rating will not apply to them. Why? Because the government says that the purpose of zero rating is to encourage export, not to encourage the re-import of the goods. Further, it says, have been entered for export under section 131 but are not exported. Now, let's try to understand that what do we mean by this. Basically, what happens is if you want to export the goods, you need to register those goods. I mean, the goods declaration is filed, a manifest is filed with the custom authorities. The goods are registered with the custom authorities that they are being exported. They are being exported, but they are actually not exported. So if the goods which have been registered with the authorities as they are being exported, but they are actually not exported till now, so such goods will also be, the such goods will also be, the such good will also be not subject to zero rating. Next, have been exported to a country specified by federal government. So I've been exported to a country that is specified by federal government, that a country, if you supply goods to XYZ country, let's say I take an example of India, say if you supply the goods to India, you will not be able to claim zero rating. So if it is like that, then the zero rating won't apply. So it's just that the government has mentioned a specific country on which usually what happens is when you've got a poor trade ties with any country, then you prohibit, then you try to discourage people to export into that country. So you may actually withdraw the zero rating from that country's export, so that if somebody is exporting out of your own country, so he would not be able to claim a refund of those exports. Now let's move. Oh, it says such other goods as may be specified by FBR through a general order as supplied by decision person so and so, etc., etc. Now, I hope you get it. So basically, what have we done? We have discussed these four things, which is what is an exempt supply, what's an zero rated supply, what's a taxable supply, and this is what we have actually done. Now, there's one more type of supply which you people need to understand, and that is called reduced rate supply. In fact, two types of there. One of them is called reduced rate supply, and the other one of them is basically called, one of them is a reduced rate supply, and the other one of them is called items under third schedule. Now, what is this reduced rate supply or item under third schedule? So there are few goods on which, like textile items and so on, the government has specified a reduced rate of, let's say, 8% on them, that a general sales tax of 17% won't be applicable, and an actually reduced rate of, let's say, 8% is going to be applicable. So that's called a reduced rate supply. What is it termed as? Reduced rate supply. Now let's move a bit forward. If I move a bit forward, then there is this third schedule item. Now, what do we mean by third schedule item? Let's try to understand. The third schedule item actually means a goods on which sales tax is imposed on ultimate retail price and collected from manufacturer. Goods on which sales tax is imposed on ultimate retail price and collected from the manufacturer. Okay, Zishan, can you just repeat? A general question is whole of the input tax adjustable or some output tax must be paid? Well, I did actually demonstrate one of the calculations here in my output tax working, so I'm just going to give you an idea. See here, it says the output tax on sales is this, and there is this 90% of output, and then there is this input. So whichever is lower off, it's claimable as an adjustment. So not necessary that some tax is to be paid. At times you might not have to pay some tax, but generally what happens is the government would encourage. There is a section 8 capital A, which actually if it is applicable, then usually 10% of output tax is required to be paid. But if that is not applicable, then that 10% of output tax is not required to be paid. So it actually depends upon the applicability of a section which is called section 8A of the Sales Tax Act. Okay, let's move forward. So if I talk a bit further, so I was actually on to this reduced rate and third schedule item. Now what is this third schedule item? Let's try to understand. When we talk about the concept of third schedule item, a third schedule item actually means those goods on which the government has actually prescribed that the sales tax be paid by the manufacturer on the ultimate retail price at which the goods will be sold in the market. So generally speaking, what happens is the packaged items, like for example, you've got cement, you've got a packaged item on which the retail price is, you've got biscuits, you've got chips, you've got tetra packed milk, you've got juices, you've got water, mineral water, etc. These are those things on which the ultimate retail price is mentioned on their packing. So if the ultimate retail price is mentioned on their packaging, so what actually happens is because of the mentioning of that ultimate retail price, because of the mentioning of the ultimate retail price on those packaging, um, the government, what it does is that it says that usually such items are supplied in a supply chain in which majority of the people are unregistered. Now remember, if the people are unregistered, the government's tax collection will go down. Why? Because if there is somebody who's unregistered, then the supply chain breaks. And if the supply chain breaks, the government's tax collection goes down. So in order to cover this up, what the government it does is, it usually what the government does is, government puts those items into the third schedule, that anything which is in third schedule, you have to pay sales tax on it, on its ultimate retail price. So they're going to collect it from the manufacturer, and the manufacturer can then pass on this specific sales tax to the customers. Like, see, this is third schedule. It says fruit juices and vegetable juices, ice cream, aerated waters or beverages, syrups and squashes, cigarettes, toilet soap, detergent, shampoo, toothpaste, shaving creams, etc., etc. Tea, respective subheadings. Now, what is the subheadings? The customer specific headings, like is packaged tea. If you buy open tea from the market, that open tea is not subject to sales tax because that's not packaged. The sales tax is not mentioned. Spices sold in retail packaging bearing brand name and trademark, like you buy a Shan masala, you have to pay tax. But you buy a red chili powder from a general Kiryana store, you don't have to pay sales tax. Shoe polish and shoe cream, so and so, so and so. Cement sold in retail packaging. If the cement is sold in a loose packaging, sales tax on manufacturing stage is not applicable on it. Like at times it's exported and so on. Biscuits in retail packaging with brand name, tiles, auto parts, etc., etc. So the third schedule item, there's a list that these are those items on which the sales tax is payable by the manufacturer on the ultimate retail price, which will be applicable. Anyways, so that marks the basic conclusion of the basic definitions. So we have discussed these various types of supply. Now let's just move a bit forward and let's try to discuss few more definitions. That what exactly are the few more definitions? Well, there are various definitions that are mentioned here. I'm not going to be discussing all the definitions right now. I shall only be discussing few of the definitions because they are important. And those few of the definitions because they are important, and then I shall be going through one of the exam practice question. So you can have a good idea about how it goes about. Now let's see. First of all, let's talk about the supply. Okay, Zishan, your question. When a retailer sale, um, when a retailer sells third schedule items above the price mentioned on the product, what are the tax implications? Well, there are no tax implications. There are no tax implications. It's actually just that the retailer actually made an income. There are no tax implications on it. Okay, for example, we get mineral water on higher and luxury hotels. Well, what happens is, generally speaking, those hotels, what they do is that they charge sales tax on a higher price. So, if you have collected an extra tax over and above what should have been collected, then you should deposit that into the government. But generally, for example, if a retailer who is not registered for sales tax purposes because you're not registered, and if you are not registered and you sell at a higher price, then no tax implication actually arises because you're not registered. So when you get registered, you have to. So basically, if you are a retailer and not registered, so this is how things go about. Okay. Um. Okay. Now let's move forward. So let's talk about the definition of supply. Okay, Zishan, your question is if somebody gets registered. Now, if somebody gets registered, then if he charges an extra tax, then he needs to pay that tax to the government. Because what happens is then he declares his sales. Generally speaking, I mean, I'm going to share with you two things. One of the practical aspect is what people they do is they don't declare to the government that they have made sales of XYZ. They don't declare the actual sales to the government, but in case if they do declare, then they have to pay sales tax on whatever sales that they have made, irrespective of whether the ultimate selling price is not being followed and they have charged at a higher rate. So they will have to pay tax to the government at a higher rate. Now let's move forward. So it says the first definition is the definition of supply. So I am going to talk about it. that what do we mean by supply. If I talk about the supply, let's try to discuss. The word supply, it says the term defined in section so and so. A supply is a sale or other transfer of the right to dispose of goods as owner, including such sale or transfer under a hire purchase agreement, and also includes. Now, very important point. What is supply? So it says the supply is actually what? When we talk about the concept of supply, it says it's a sale or other transfer of the right to dispose of goods as owner. So if you transfer the goods as owner, or you transfer the right to somebody to dispose of the goods, that means you have made supply. It says including such supply which is putting to private or business or non-business use of goods produced or manufactured in the course of taxable activity for purpose other than making a taxable supply. Now let's try to understand what do you mean by this. For example, you operate a factory, and it's a biscuit factory, and what happens is you take a pack of biscuit to your place, your home. When you take a pack of biscuit to your home, your place, that is going to be considered as supply for the business. That is going to be considered as a supply for the business. Number two, you manufacture biscuit and the guests come in. What happens is you withdraw some biscuit packs from the you withdraw some biscuit packs from the factory premises, and what you do is that you serve those to the guests that come in. So that is actually putting those to the business use. The third thing is, um, you have a biscuit factory and you want to give a souvenir or give away of those gifts in your personal capacity. So that's a non-business use. You withdraw some biscuit packs and you disperse them as a gift to somebody. So that is also going to be considered as a supply. So what is supply? Supply is anything that actually leads to you parting ways, or you parting with the ownership of the goods. So that is actually going to be considered as a supply. Now let's move a bit forward. Furthermore, it says auction or disposal of goods to satisfy a debt owed by a person. For example, you give a bank some goods as a mortgage, as a security, and unfortunately what happens is you default on the payment of the bank. So if you default on the payment with the bank, so what happens is um, that due to the default, what happens is due to the default, the bank, what it does is that it auctions the goods that the bank had purchased from you, or the bank had actually kept as a security from you. So if the bank is gonna um, dispose them off in order to settle the debt owed to them, so that is also going to be considered as a supply made by you, as a sale made by you, because you would have sold them to the market, you would have recovered the money out of them, but now you have not recovered. So basically that is also going to be considered as a supply. Let's move a bit forward. It says possession of the goods held immediately before a person ceases to be a registered person. Now, what do I mean by this? Immediate possession of the taxable goods held immediately before a person ceases to be a registered person. What does this mean? For example, you're not you're not registered anymore. Like for example, um, you are now, I mean, you were registered, now you want to actually get deregistered. So if you want to get deregistered, so immediately before the deregistration, whatever the goods that were held by you, that would be considered as the supply of goods made to you. That would be considered the supply of goods made to you. Now what next? It says in case of manufacture of goods belonging to another person, the transfer or delivery of such goods to the owner or to a person nominated by him. In case of manufacture of goods belonging to another person, the transfer or delivery of such goods to the owner. For example, you have got a factory in which you manufacture various things like if somebody gives you steel, you'll manufacture the steel drums for them. If somebody gives you raw plastic, you will manufacture plastic drums for them. If somebody gives you, I mean, whatever they give you, you'll manufacture XYZ things for them. So even though you are, even though you are actually delivering their own goods to them, but they are being delivered to you for the manufacture, for further processing. It was a raw steel that was being given to you to manufacture drums. It was a raw plastic given to you to manufacture the plastic drums. So what happens is this is all going to be considered as supply. So important thing is definition of supply. Any questions with respect to the definition of supply? Okay, let's move forward. So basically the definition of taxable goods, a very important definition. As I mentioned earlier, there are few definitions that you need to have an idea, a good idea about before you can attempt any of the questions. Is that now the taxable goods? What does it say? It says taxable goods mean all goods other than those which have been exempted under section 13. Okay, it says the term goods is elaborated in the following way. Now, goods include every kind of movable property other than actionable claims. Now, what do you mean by this actionable claims? The actionable claims actually means coupon. Like you have got those BOGO vouchers. The BOGO vouchers that we have, buy one, get one free vouchers. They are actionable claims. So actionable claims are not goods. In case if you exercise those actionable claims, so resultingly what happens is you get goods out of them, so that is okay, that's good. The money or the stocks or shares or securities. So stocks or shares or securities is basically your shares, debentures, TFCs, etc., bonds. They're all not considered as goods. So anything other than them is considered to be supply of goods. So anything other than them is considered to be supply of goods. Now let's move. Next thing is I'm skipping the definition of manufacturer, etc. I need to discuss the definition of value of supply, a very important definition, which is about the value of supply. So let's have a discussion about the value of supply. It says value of supply in respect of taxable goods, the consideration in money. The consideration in money, including all federal and provincial duties and taxes, if any, which supplier receives from recipient for that supply, but excluding the amount of tax. Obviously, you made a supply of 100,000, the sales tax on it was 17,000. So the value of supply would be 100,000. Value of supply would not be 117,000. Further, it says provided that in case consideration for supply is in kind. When we say the supply is in kind, consideration in kind means other than cash. The consideration in kind means other than cash. So it says in case the consideration for the supply is in kind or is partly in kind, that is partly cash, partly in kind. It says the value of supply shall mean the open market price of the supply excluding the amount of tax. So like for example, I sell the goods, and the consideration that I received in return was, let's say, goods worth, or I mean whatever the benefit in kind that I receive was basically worth, let's say, 500,000, but the actual supply that I made was worth only 300,000. So what would happen is the value of supply would be 300,000. The value of supply would be 300,000. Now let's move forward. The second thing is, in case the supplier and recipient are associated person, a very important concept. And the supply is made for no consideration of a consideration which is lower than open market price. The value of supply shall mean the open market price of the supply excluding amount of tax. A very important point. Now, basically what happens is, what do we mean by associated person? The associated person, there is a definition in the Sales Tax Act with respect to the associated person. But generally speaking, what happens with the associated persons is, associated persons are those which are connected to each other, like maybe a subsidiary or an associate, things like that, that is considered to be associate person. So generally what happens is the associated person transaction with an associated person is a related party transaction, and it's usually not an arm's length transaction. So for example, if your transaction is not an arm's length transaction, so the Sales Tax Act, it says that irrespective of whatever the sales tax value that you have agreed to, but if it is not an arm's length, if it's at a different price, then the sales tax value for the supply purposes for the application of the sales tax would be the value of the supply at an open market price. It would not be whatever that you've agreed. It would be an open market price. Third thing, it says in case a supply is made to a consumer from general public on installment basis, just like we go for hire purchase or for the leasing, on installment basis on a price inclusive of markup or surcharge rendering it higher than open market price, value shall be open market price. Like for example, the market value of a good is, let's say, 20 lakhs, but the payment that you'll make is 25 lakh. So this 5 lakh is actually for the interest. This 5 lakh does not increase the value of the goods. It's actually for the interest. So this is not going to be included in the value of supply. The value of supply will only be 20 lakhs. Further, it says in case of trade discounts, a very important point. In case of trade discount, remember, it's not an early settlement discount, it's a trade discount. So it says in case of trade discounts, the discounted price excluding the amount of tax provided. The tax invoice shows the discounted price. And the related tax and discount allowed is in conformity with the normal business practice. So like two things. One of them is trade discount. What is it? Trade discount. The cash discount is not discussed here. It's a trade discount that's discussed here. So if there is a trade discount, and if it is mentioned, if the discounted price is mentioned on the invoice, and the discount allowed is in normal business practice, then the discounted price is going to be the value of supply. Next is, in case of a special nature, the open market price. In case of imported goods, the value determined by custom authorities, so on and so forth. In general, what happens is, it's the open market price that is considered to be the value of supply. Now let's move a bit forward. One more important thing, which is basically called the time of supply. So if I discuss the concept of time of supply, let's try to understand what do you mean by time of supply. A very important thing is, because what happens is, with respect to the sales tax, you file a monthly sales tax return. The sales tax return is filed on a monthly basis. So the period for which we file a tax return is for a monthly basis. For a monthly basis. Now let's try to understand. So what is the okay? Is discount will be allowed to be deducted from the price of third schedule to a certain value supplied to apply tax? No, no. Um, the third schedule item, it's the manufacturer who is actually going to be um, if, like for example, if a manufacturer reduces the price of the supply, like at times what happens is you give a discount on the on sub product. For example, Pepsi prices goes down in Ramadan, so the reduced price is the retail price, and the sales tax will be imposed on that reduced price. Over here, it's actually the manufacturer who publishes the ultimate retail price. So whatever the price that the manufacturer is going to publish, that is going to be considered as the price on which sales tax will be applicable. Now let's try to understand. It says time of supply. When we talk about the concept of time of supply, it says in relation to a supply of goods other than under hire purchase agreement, means the time at which the goods are delivered or made available to recipient of supply, or the time when any payment is received, whichever is earlier. A very important point. It says the time when goods are delivered or made available, or when the payment is received, whichever is earlier. For example, if you have received payment in this month, that means the supply is made in this month. If you have received payment in this month, that means the supply is made in this month. So the important thing is you need to understand that what is actually happening. It's either the earlier of the date when the goods are made available, or the date when the goods are delivered, or when the payment is received. So even if you receive partial payment, so whenever you receive the partial payment, that partial payment is considered to be the time of supply, and that is what it is. Now it says in supply of hire purchase agreement means the time at which agreement is entered into, and services means the time at which services are rendered or provided. Now it says if any part payment is received, it shall be accounted for in the return for that tax period, and in respect of exempt supply, it shall be accounted for in the tax period during which the exemption is withdrawn from such supply. So in case if you have supplied exempt goods and the exemption is withdrawn on those goods, then what happens is the period in which the exemption is withdrawn, that is going to be the period on which the sales tax, the supply is going to be considered has been made. Okay, so what I am going to do now is I am going to actually refer to one of the exam questions so that we could have a good idea. Now, for all of you who want to know the past paper for the taxation are available on the ACCA's website. You can download them from there. So I shall be using this December 18 exam question. So they are available on the ACCA's website if you, in case if you want to access. Okay. Um, what we shall be doing is, this is one of the questions, which is basically a taxation question for December 2018. So what I would actually want you to do is that to try and attempt this question, because it says calculate sales tax payable or refundable to Masood for the month of May, giving explanations for the treatment of the following: the trade discounts allowed, the goods given, and the input tax not claimed in the return in January. So let's actually go through this question, then we shall discuss. What you need to do is that first thing is you need to go for the computation of the input tax and then the output tax, and this is how you're going to progress. Just go through it and then we'll discuss. I hope you can see the whole question now. Okay, so let's just start discussing about this question. First of all, we will discuss it and then we will try to attempt it. So it says, for the purpose of this question, you should assume that today's date is 5th June 2018. Now it says Masood Enterprise Limited is a registered person under Sales Tax Act 1990 and is engaged in the manufacture of consumer goods chargeable to tax at 17%. So it's engaged in the manufacture of consumer goods which are chargeable. It's engaged in the manufacture of chargeable goods which is subject to sales tax at the rate of 17%. It says the company's business transaction for the month of May 2018 were as follows. So what were the transaction for the month of 18? Now let's see. It says sales including exports exclusive of sales tax. Now remember the word exclusive of sales tax. The local supplies to registered person is 20 million. Local supplies to unregistered person is this, less the trade discounts at 10%. And then you've got exports of goods to Egypt. Then it says purchases of raw materials inclusive of sales tax paid through cross-check. Paid through cross-check. Now it's important that when you purchase the goods, you need to pay through banking channel. When you purchase the goods, uh, they have to pay through the banking channel. Now let's see. So it says that purchase of raw material inclusive of sales tax paid through cross-check. If you don't pay through banking channel, then the input tax is disallowed. If you don't pay through banking channel, then the input tax is disallowed. Now let's move forward. Further, it says that in addition, MEL's records show that the rate of discount is well below normal business practice in the industry. Discount rate was not shown in the sales tax invoice. So basically what happens is, irrespective of whatever happens, this discount is not going to be allowed. It says goods with a total value of 100,000 were provided free of charge to the executive director of MEL in accordance with his terms of employment. Now what happens is, if it is being supplied to him free of cost, so that doesn't actually matter, because the definition of the value of supply actually indicates that the value of supply is the open market price. So if the goods were worth 100,000, so the value of the goods is going to be 100,000, irrespective of whether you have charged something from the customer or not. 100,000 is going to be what the sales tax is going to be applicable upon. Now, it says there is no record of payment for purchase of raw material for manufacturing taxable local supplies of 351. This amount is included in purchase of raw materials. Now, if you purchase the goods and if you want to claim input tax on those goods, then you should have a copy of the invoice available with you. If you purchase the goods and if you have got if you don't have the sub purchase invoices available, you cannot claim input on them. You cannot claim input on them. Further, it says due to an oversight, input tax of 200,000 relating to the purchase of raw materials used for manufacture of exempt goods was not claimed in January, so you forgot to claim. Now, further, it says the payment of 11.7 million was made in May 2018. This related to capital goods for installation in the manufacturing unit. Now, try to understand few things and then we are going to move forward. So I'm going to be using the Excel to perform the calculations. I'm going to be using the Excel to perform calculations. Okay, so the first thing that we need to do is that we need to perform the calculation for the input tax. Now, how exactly are we going to perform the calculation for the input tax? So if I talk about the input tax, this is an input tax calculation. You've got this details, and then you've got the amount, the taxable value, rate applicable, and the sales tax. Now, um, so basically what happens is the purchases of raw material for manufacturing taxable supplies. Raw material for taxable supplies. The value is 52 million. The sales tax rate is 17%, and the sales tax would turn out to be this multiplied by this. Okay, now, so this is what it is. The sales tax on this taxable supply, taxable value is there, the rate is there, etc., etc. These are theirs. Now, what next is there? It says purchases of raw material for manufacturing exports. Raw material for exports. Okay, whatever the raw material for export is, it's 18 million. And what happens is you would have paid the sales tax on it. Now, what next is there? The next situation which we are going to talk about is it says um, there is no record of purchase of raw material for manufacturing local taxable supplies of 351,000. So what I could probably do is I could just put it here, less records not available. So it's negative 351,000. So the input tax which is calculated on it would be disallowed. Further, it says due to an oversight input tax of 200,000 relating to purchase of raw material used for manufacture of goods not claimed in January 18. Now try to understand this thing that you can claim. Um, you can claim input tax in case if you've forgotten in a period, then you can claim during the next 6 months. So like it's going to be 200,000. So what happens is input tax not claimed earlier will be 200,000. Further, it says payment of 11.7 million inclusive of sales tax was made in May 18. This related to capital goods for installation and manufacturing. Now further, it says that capital goods so this is how the sales tax is going to be. Now the entire sales tax input is going to be like this. Further, it says um, now this is how input tax is computed. So once we have computed the input tax, we now need to move forward and we now need to discuss the output tax. There are few adjustments that need to be made to this input tax, which I'm going to explain a bit later because I have not explained all the concepts right now. But let me explain to you whatever that we have done up till now, the output tax. So when I talk about the output tax, first of all, it says local supplies to registered person. So supplies to registered person is 20 million. Then supplies to unregistered person. Supplies to unregistered person. and that amount is actually 225 million because the discount was not in a conformity with the terms and the conditions. There's actually going to be a further tax applicable on it also. I will talk about the further tax also. Now, what next is there? The next situation is export of goods. Exports are basically of 18 million and they're going to be charged at 0%. Then, furthermore, sales to executive director. You may not have charged the money, but you'll have to treat it as a supply. Okay. So this is what it is. So this is the output tax on sales, and then what you do is that you add further tax. So when I talk about adding the further tax, what happens is the further tax is basically on this supplies to unregistered person. So resultingly what happens is this is what you get, and hence so we have got input tax, we have got output tax. We have performed the calculation for both the input and the output tax. Now what next do we need to do? So the next situation is basically the computation of sales tax liability. So let's try to understand that how do we go about computing the sales tax liability. If I talk about the sales tax liability, I would say output tax. The output tax is going to be this 7667. And then what happens is adjustable input tax. So it's actually 90% of output. Basically what happens is you're not allowed to adjust the entire sales tax, but instead it's only 90% of output. And what happens is you need to deduct this less export related. Okay, so you've got output tax which is available 7667. The adjustable input tax which is 90% of the output is this, and the actual input tax is this. The actual input tax is this amount. So the amount that is adjustable is basically lower off. And then you add further tax to it. Then you add further tax to it. So if you add further tax to it, which is going to be of 500,000, so resultingly what happens is the balance tax payable slash refundable. is going to be the sum of all this, which is this is amount payable. The sales tax carried forward. Now, what do we mean by sales tax carried forward? So it's basically the difference between these two. This minus this is the sales tax carried forward, and sales tax refundable is going to be pertaining to the imports, to the exports, is 3060,000. Now, okay. So now, if I sum up, so basically what happens is, if you have any questions pertaining to it, do ask so that I could actually discuss it. Now, the raw material for exports, we have mentioned this is what it is. The raw material for taxable supplies, this is the sales tax we paid for it. Less the records for the goods which were not available, you cannot claim input for that. Then you've got the capital goods. Now there is something that I need to explain with respect to the capital goods, which I'm going to explain in tomorrow's session. Then it says input tax not claimed earlier. So yes, you can claim input for that. Um, then what else is there? Less the export related. So the export related, what happens is you cannot claim adjustment to it. You just have to claim a refund for it. Further, when we talk about the output tax, so the output tax is supplies to registered person as this, supplies to unregistered person as this. Then there are these exports, and then the executive director sales is considered, further taxes imposed, and so on and so forth. Once we talk about the sales tax liability, this is something which I'm going to explain again in the next session. And 90% of output and then input actual, there's also going to be some of the changes pertaining to it, which I'm going to explain again, because we need to understand few things which can't be explained immediately. For this, we need to spend some time. Then there is this lower of this, the add of the further tax, so the balance tax payable. Now, the 90% of output was this, the input was this. The sales tax which is carried forward is this much. And the sales tax refundable is going to be this amount which is pertaining to the export. So I hope that this is fine to everybody. Okay, so we have actually gone through the basics of the sales tax, and we have actually um, performed a calculation for sales tax also through one of the exam questions. And I think basically this is a basic concept of the sales tax that you people have now gotten. So what we actually need to now do is that we need to now move forward and discuss further about it in our coming session, which is inshallah going to be tomorrow. Okay, so basically this is how it is. What we shall do is that we shall now keep our session till here today. We will inshallah be continuing tomorrow, and we shall be discussing further, which is going to be further aspects of the CS tax. That's what we are actually going to be discussing. So thank you very much for attending the session. Thank you very much for taking out time to attend the session. I hope that the session would turn out to be a fruitful session for you all. We will inshallah resume again tomorrow at from this 8 p.m. Pakistan Standard Time till 11 p.m. So till then, thank you very much. If you have any question, please do ask. Okay, so thank you very much. Thank you for attending the session. Let's actually discuss tomorrow. We'll move a bit further. Thank you.